Ladies and gentlemen, welcome to another edition of Independent View with your host, Lobo Tigre. Our guest of the day is my old school chum, Egon Vorfeld. It just so happens it was Egon's birthday. So, Egon, are you 21 yet? Did you get keys to that house and the car?
Nearly. 26 maybe. So keys in the pocket. But yeah, whether they let me back in the house, I don't know.
Well, happy birthday, Egon, and thank you for taking time to talk to us today. I'm really keen to have this conversation. It's become sort of a yearly ritual with us to get your take from the other side of the pond, which I think is valuable just in general for all investors. A balanced conversation, if you will. But particularly right now, we've got a war on your eastern front there, Eastern Europe, and sanctions. I mean, the world is really quite different, on top of the whole COVID-19 situation from the last time we talked. So lots of things we can get into. Try to be pithy here and not make this take too long, but just quick overview from the European perspective. First, on the kinetic war. Is there really any fear or thought in the investment community that that could really spill over, or do most people just sort of compartmentalize it? It's Ukraine, it's bad, but it doesn't affect us directly.
Well, first of all, it's a huge tragedy what's happening, and we're all very much touched by it and emotionally, I would say. We see tens, if not hundreds of thousands of refugees piling across the border for good reason, and but being welcomed, and I think that's interesting as well. Countries that were perhaps less keen on immigration from North Africa and places that we've had in the recent past, and the Middle East now are much more inclined to welcome the refugees coming from the Ukraine. So it's definitely a tragedy at a human level.
Sorry, I got to jump in there. This is not the conversation I wanted to have, but since you went there, I have to ask, and maybe it's neither here nor there for you and I. And by the way, I have friends and dozens of former students in Ukraine, so personally, this is very near and dear to my heart. But I'm trying to deliver value to investors out there. But since you bring it up, there's horrible things happen in Africa where the machetes come out and there's horrible brutality there, and I haven't seen quite the same open-armed response. And I have to wonder if there isn't a little bit of racism in how welcome these white people from Ukraine are. I don't know if we're going to solve that problem, but
I don't think it's. I mean, I don't necessarily think it's a sort of racist issue. Maybe there's a little bit of that going on here and there, but I think it's when your brothers next door are invaded and are being bombed, and women and children are being killed and bombed, and it's literally for us it's literally next door. It's only hours drive away. I mean, it's a bit like if California went to war with Texas, and the states sort of east of Texas say, well, come, welcome. It's different than when people start jumping across the border from Brazil, So you got to think of it a little bit in that context.
Fair enough.
So it's a human tragedy. We are all amazed by the resilience of the Ukrainians. So in terms of the impact and expectations, also on stock markets and on the economy. I mean, we thought, we didn't think it was going to happen, and when it did happen, we thought it would probably be over very soon. Russia being the powerful nation it is, we thought, this is a question of days or weeks.
And mea culpa on that too. I had the exact same thought. Sorry, go ahead.
But so the huge surprise as to the resilience of the Ukrainians. And looking more into it, one can explain it, but let's not really go there in great detail. But they'd obviously been preparing for it because they were actually invaded in 2014, Crimea, and they were also fighting already actively on that eastern border in the Donbass region. So they were probably much better prepared than we actually ever realized. The economic impact, and that's another aspect, obviously, we thought would be minimal because, in terms of the global economy, the Ukraine is obviously minuscule as an economy in terms of GDP. Even Russia, as part of the global economy, is actually a very small part. So we weren't overly concerned about the economic impact. And in terms of markets, just very, very short, we've seen many wars, many conflicts in the past, and we analyzed it all the way back to even the Pearl Harbor. And what's striking is that markets tend to bounce back within months almost of almost all of these conflicts. So when it happened, certainly from an investment perspective, if that's a question you were going to ask me, we held. We did not run for the mountains. We held our positions, and we were fairly confident the markets were going to have a decent bounce fairly soon after, like it happened before. Now, obviously, since then, many other things have happened, which we can talk about.
Well, yeah, that's the segue. The kinetic war. Okay, and it still seems fairly contained. I mean, there's worry about chemical weapons possibly blowing over into neighboring countries or tactical nukes, which it would be hard to contain the residue of. But so far, none of that has happened. It seems that the mechanical fighting is still contained in that area. So that takes us to the economic war. And this is, I think, what surprised everybody more than anything was how the West really did come together and put together sanctions that were much more than the wrist slap. I mean, the last time this happened in 2014, Putin basically got away with it.
Yeah.
And I'm not surprised he was emboldened to try again. So, and like you, I thought it'd be over quickly. When it wasn't, I didn't think the sanctions would be as powerful as they have become. And now that's really the story. The economic war is reshaping the investment really across the world in everything. Not starting with energy, which influences everything, but in other things too. So, from your side, sitting there closer to the action, how do you see the economic war playing out? Are there any deliverables that investors should keep in mind as a consequence?
Yeah. So from an economic perspective, it has really pushed inflation higher and making it a lot more likely for it to last longer. Because we were more in the transitory camp at the beginning of the year. Because again, inflation, the best thing against inflation is inflation itself. And the base effect was going to start happening. So we felt, and some of the factors, certainly at the beginning of the year, affecting inflation, looked to us as temporary factors. Now, obviously, with the war in Ukraine, that's changed. And certainly also with the zero COVID policy in China, that's changed. So two very specific things have happened, which now make inflation definitely higher and last longer. And that's for not just in Europe, that's for everyone around the world, I think.
Yeah, we've had quite the parade. The World Bank yesterday, OECD today, cutting their growth forecast. Still forecasting growth. I think they're a bit optimistic. Do you want to weigh in on that? Do you can you actually see a recession ahead?
We're eternal optimists, so we do believe. There is a lot of. There's a huge lack of visibility on any of this. So one has to put a lot of caveats in place before making any kind of predictions these days, especially in this environment. But we're still hopeful that we're going to be able to come out of this with low growth, reasonable, inflation. If you put a timeline on it, it's very difficult. But it's next year, hopefully next year, things will, inflation will have abated to a large extent, and growth will have dipped. Maybe it will briefly go below the zero line. But we're not expecting a full-blown recession. We're really hoping the Fed and other central banks are not going to make the mistakes they've made in the past.
Unlike me, you actually did study economics, I remember, at Erasmus University. I'm just an amateur. But let me ask, if I can dial in on one aspect of that. it strikes me that one of the things that the powers that be are counting on are the base effects to make this year's inflation numbers, like particularly right now, the increases last year were so big that it's hard to add, another 8% on top of what happened last year. So they're kind of hoping that it'll look like inflation comes down already without them having to raise rates too much. But is that real? And you know what? Even if it does, if we have, a high comparable, if you had 4 or 5% last year and you add 6 or 7 now, over that 2-year period, you're looking at double-digit inflation. So that's a high increase in cost of living. So in the real world, how important is this? And what do companies do if their customers start, saying, "Oh, I don't care if it's not as high as last year. I don't feel wealthier. I don't have money." What's the real world impact here, Egon?
Yeah, well, I think there is real world impact, and we're concerned about it. But everyone adjusts, and there will be, a lot of the inflation may also be linked to people, putting up their inventories too high, which then, like some of the news items we've heard of Walmart, Target, I believe in the US, where, they bought too much. There was a lot of hoarding, causing high inventories, people buying 12 months worth, even if they only need 3 months worth, and stuff like that, and then eventually ending up with inventory they need to sell at lower prices. So that could be deflationary. It's difficult. It's difficult to know exactly how all the numbers are going to work, but you're right. It is going to be painful, and the only way to absorb that is by to some extent wage inflation, which is happening, and maybe some economic growth, but that takes time. So in the short term, it's a very painful phenomenon.
So you say you're eternal optimist, but are you retrenching your portfolios now, going more defensive? What is an investor to do in the face of this?
Yeah, so last year we reduced our equity exposure somewhat, and certainly fixed income exposure, because we talk about the equity markets, but my God, the bond markets have got hit like never before. So we were reducing our fixed income exposure, and in fact been very, very underweight investment grade for a very long time, probably way too soon, because we never imagined negative interest rates as we have done. But the shifting of portfolios has been last year already out of equity, a little bit. Well, we were still overweight equity, but reducing somewhat and making some changes and ensuring having diversified portfolios. Because the only way you can truly protect yourself is just by being diversified. So we've just been focusing on diversification, making sure we weren't too growth, but also sufficiently value, making sure we weren't too small cap, but also grow, a bit large cap, making sure that we were spread across the globe, in the US, but also in Europe and elsewhere, and some pockets, or sort of rather unusual pockets, which I can talk about. And definitely, yeah. So and in this year, I would say a little bit of shifting more towards the defensive side. But where we had exposure to small cap growth, we got hard hit, and these are we often use funds. We select fund managers rather than do individual stock picking. So a lot of these guys who've been creating phenomenal alpha over many years, suddenly are not looking so pretty. But those positions we've tended to hold because we feel the underlying quality of the businesses are in fact very strong. So we just have to sit it out on some of those positions. A bit similar to perhaps some of your mining companies that well, you love, they have, but you may not add right now, but you're just sitting because these guys are good quality, they're going to last, and they're going to bounce at some point.
They're not going out of business. So on that, you didn't mention the C word. Is any of your restructuring going into commodities?
Well, we have an allocation to gold bullion, some cases also to silver, and an area that has worked very well for us and we've talked about this before, uranium mines, and that certainly last year was good, and this year again it's corrected recently, but we think that's in fact a buying opportunity. But we can talk about that too if you like.
Yeah, I'll come back to that. I definitely want to talk about uranium. But while we're talking about stocks, there's a question I've had in my mind that just sort of came clear when I thought about talking to you today. I actually get a lot of pushback from readers from time to time because I focus on the U.S. markets and the impact on the dollar of the markets, the economy, and things here. And it's not that I don't know that there's a big world out there and there's more than the U.S. markets out there. But since I am a commodities-focused guy, and commodities are priced still in dollars largely, what happens to the dollar is very important in all my investments. But you're a generalist. You're not just a commodities guy, and you're in Europe, and most of your clients are in Europe, I assume. So I'm wondering, from the perspective of your clients, how important is the U.S. market? Am I being too provincial despite being a commodities guy, or does it matter to you guys as well, or is it,
Well, it really matters. I mean, the U.S. as an economy it's obviously the largest economy in the world. The U.S. dollar is a currency that not only is used in the U.S. economy, but for commodities and around the world. For most of our clients, and I think it's true for everyone here in Europe, the U.S. is a key market, forms a key market of our portfolios, our asset allocation, and the exposure to the U.S. dollar is significant for many clients. So what happens in the U.S. is great importance. It's often a leader to what then later happens in Europe. So we're always watching what's happening in the U.S. It's a great indicator of what might or is likely to happen in Europe. And we're exposed. We're very much directly exposed, either in the individual investments, but also simply through the currency. So we watch the U.S. like a hawk.
Well, that is interesting. Okay, so I'm not just being too provincial. That would have been my guess. But one thing that you said in there that was not clear on my radar is how much U.S. stocks are part of people's portfolios outside of the U.S. In retrospect, I should have understood that. It seems like an obvious thing. You invest in the biggest market.
And just to illustrate it, I mean, a lot of our clients will look at the MSCI World Index as a benchmark when they look at their global equity portfolios. And the U.S. represents 60% of that. So it's by far the biggest market. I mean, China is the second largest economy. So we look at China closely too. It's the other spectrum, other side of the world for us. But it's of great importance what happens in China for many reasons. First of all, because obviously it supplies the world with most things. So any supply chain issues in China have great impact on the companies we're invested in Europe. It's a huge economy, but as a market, as a financial market, it's still tiny for us. It represents 40% of the MSCI Emerging Market Index, but most portfolios are not necessarily invested in emerging markets.
Understood. That makes perfect sense. I want to go back to something else you touched on earlier before I talk about specific commodities, including uranium. You talked about bonds, and maybe you can help me understand something. I look at people who are buying the dip, if you will, on bonds, or I'm not really sure why they're buying, but there are days where, for no particular reason I can see, people pile into bonds, particularly here in the U.S., and that just strikes me as crazy because the Fed's going to be selling. I mean, they're not going to be. They are selling. They're saying they're going to be selling a lot for months and months ahead. I mean, they've got a big job cut out. Why would anybody jump in front of that steamroller? What am I missing? Is it a short-term trade that I can buy today and sell in the next blip? Or why would anybody do that?
Well, I think that there's two things about bonds. One is the credit risk you run, i.e., are you going to get your money back? And the second thing is, what am I getting paid for taking that risk, whether or not I'm getting my money back? Because you're basically lending somebody money when you're buying a bond. So, firstly, the actual credit risk seems quite, let's say, has improved a lot over the years because a lot of companies and governments have been able to borrow at virtually nothing and been able to refinance their balance sheets at very advantageous rates. So in general, one can say with some certainty, and that's also true for the high yield space, that balance sheets are in reasonably good nick, and the cost of financing is low for a lot of these companies and even some governments. But obviously, the more they're invested in and have to refinance going forward, the rates are going up. So the future cost of capital for all these parties will increase, and that is a concern. So one does the credit analysis first of all to see how likely these guys can actually pay me back in 3, 5, or 7 years, or however long the bond lasts for. And then you look at, but if you're comfortable with that, then you look at the yield. And if you buy it today, you know what the yield is on that instrument. And as long as you hold it, that's what you're going to receive. Now, it's true that if the market takes a turn for whatever reason, either because they're become concerned about credit risk, or interest rates go up, then the actual bond you're holding will go down in value, and if you're uncomfortable with that, then you might sell it at a loss. But I think a lot of people are buying now because the credit risk seems to be okay, and certainly better than not so long ago, and the yield has just picked up a bit, so it's becoming interesting again. Plus, they've seen the sort of huge drops in the equity markets, what can happen there, and are reminded that equity markets don't just go up 10-50% every year.
But
so I think
the Barstool investor said that stocks just go up. I forgot his name. That Barstool investor guy. Stocks go up. Okay, I hear you.
But the government not buying bonds anymore, and maybe selling them, reduce. That will have an impact on the yield of the market. But,
okay.
So if you're owning something that you're happy to hold until maturity, it doesn't really matter to you what happens in the meantime. You're just locking something in.
All right, and even if the yield is negative, it's less negative than holding cash, I suppose, is one part of the answer. And if you're
Europe, it's still tricky because there isn't very much that's yielding anything positive. So you've got to have a fairly bearish view on everything else around you to want to buy that.
Understood.
But in the US high yield, it's looking a lot more attractive now than it was not so long ago.
Okay.
The spreads over treasuries have gone up to 440 now, I think. They were briefly close to 500, but those are pretty decent sort of premiums you're getting paid for, a credit risk that seems reasonable.
But is that really just Tina? There is no alternative here in disguise. I mean, because correct me if I'm wrong, but here I think most people have a sense, even in the mainstream, that inflation is higher than the CPI and PCE prints.
Yeah.
We use those numbers because those are the numbers, but I don't think anybody in their heart of hearts really believes it. You go to the store, you go to the gas pump, whatever, are you paying rent, or you're trying to buy a house? Basically nothing. Energy, right? Nothing looks like the CPI numbers. So, if you're going to buy bonds to hold a maturity for what seems like better than inflation, but it's not real. Doesn't that make your skin crawl?
Yeah, so I mean, so I personally am not very keen on it because I prefer to take a bit more risk and with hopefully at least the potential for much better returns than locking in something that I don't like the look of. I totally agree.
So
but it's a balancing of risk versus volatility. It's some people can't stomach the volatility of the stock market. So, then even if they know it's only a 3 or 4 or 5% return, they're okay with that.
Okay, and so as a gold bug, of course, I want to say, well, why not gold? I do understand how there's sort of a principal risk with gold that you wouldn't have in a bond. With a bond, you know that in dollar terms, you're going to get XY back, your coupon at the end of the deal. And you don't actually know what the price of gold or the gold dollar exchange rate will be at some future point if you were to redeem your gold. I get that, right? Gold doesn't pay interest and the price could go against you. So it in that way, it doesn't seem to compete well against a bond. But I really take objection to this, Tina, there is no alternative view of just stocks and bonds. I mean, there's other things out there. What about REITs? Like if inflation is high, why not allocate some to real estate? And okay, prices might come back to reason, but houses aren't going to zero. I mean, it seems to me that there should be other alternatives out there than jumping into bonds at a guaranteed, in real terms, loss.
Yeah. No, I mean, they are the largest liquid markets, and I think that's why a lot of people go to them. There are REITs, but again, there is a sort of limit as to how much one can invest in REITs. At an individual level, you can, but as the market as a whole, it's quite limited. But there's definitely money going, much more money now than ever before, I think, going into the private equity private buckets. So private equity, venture capital. Clearly, people have gone into cryptos. That's another new area that people are able to put their money in. I think a lot of the checks that people received in the US, ended up in not only in
we can't document that, but it sure looks that way. Boy, and those people who bought at 60,000 Bitcoin, they have to be sweating bullets now and hodling, as they say. All right, but I am a commodities guy, so let's go there. And rather than me spoon feed you, what are your favorites in that area? What are you doing with your clients' money, if I may ask?
Yeah, so for us, I mean, we're not commodity specialists, so we approach it fairly, in a fairly simple way, and the areas that are of great interest to us. So gold for us is just it's a safe haven, long-term investment. So we're not, we buy it, we have no intention of selling it, we're not speculating. We try and be clever about, when it corrects to buy a bit, and then maybe if it's had a really strong run, maybe top slice a bit. But for a lot of clients, we just hold whatever it is, a 5% position in their portfolio in gold bullion.
That's 10 times the global average. So tip of the hat to you.
Yeah. But we like some of the gold mining, silver mining, and in particularly anything that benefits from electrification. So we found a fund manager who specialized in these mining companies. So we can really see the cobalt, lithium, anything that's required to put a battery together, and also copper. Especially copper, because all that energy needs to be transported, and the only viable way that can be transported is through copper. So if you look at the demand, the likely demand in the future, and look at the supply side, I mean, there is a huge gap, and that gap's going to increase dramatically. So the only way the prices of these commodities can go is up.
Actually, let me jump in there, Egon, because we're talking about potentially stagflation, recession, the pressures on the economy, high prices cure high prices, right? So there's a sense I get in the mainstream and the broader investment community that commodity prices have got ahead of themselves, they're too high, they spiked on scare, and that they're all going to go into reverse, right? That the supply chain disruptions will work out and things will go back to normal, and commodity prices are due for a downturn. But
I think that could be true. I mean, if you look at oil, or you look at iron ore, or some of those that are very sensitive to, that are very cyclical, that are sensitive to economic growth. Sure, they're sensitive, so they're gonna have times that they'll be going down when there are worries about economic growth. And certainly oil is quite susceptible to what people, how people feel about it.
It went negative in 2020.
Near-term economic growth. But when you talk about these specialty metals, it's a very different story, I think. So I'm less worried about GDP growth when I'm looking at lithium or cobalt because of that, and copper too. So these are long-term secular trends, and we'll have waves of optimism and pessimism generally, and that will affect the price of all these commodities. But the long-term trend, the long-term secular trend, is definitely going to be up.
Well, I'm very happy to hear you say that. This is actually what I think, but I didn't want to spoon feed you that answer. So audience out there, this is a generalist. He's not a gold bug. He's not a commodities guy. And he sees these secular trends the same way I do. And I'm glad to see you emphasize copper, because I agree, whatever happens with some of these others, new battery technologies or what, they're all going to be wired with copper. So I like the whole, new energy paradigm sector as you do. But copper is my number one pick there. The other one, though, that I find very interesting that you touched on, let's go there now. Rather than me spoon feeding you what I want to hear, talk to me about your perspective on uranium.
So, we've talked about uranium before last year, I think, but we identified because we just hear a lot of stuff, right? We have 200 meetings a year with a huge variety of analysts, fund managers, any idea that crops up anywhere around the world that could be of potential interest to a private investor. They come and talk to us here in Switzerland about it first, because we're sitting on the largest pool of private money in the world. So, as a concentrated pool of private money. So I can't remember exactly how we came to the idea, but all I remember is that when it came to us, it made a lot of sense. And this is probably 2-3 years ago already now. And the basic story is, again, what I mentioned about cobalt, lithium, and copper is that when you look at the likely demand in the many years to come, and you look at the supply, there is a massive gap, which means that the price of the commodity has to go up. And in particular in uranium, where mines are being mothballed because it's the current price in the market is below cost of getting it out of the ground. So it just seemed incredibly obvious to us that maybe not in 3 or 6 months' time, but certainly over a longer period of time, the price of uranium had to go up. And then if you take into account the operational gearing at these mines, it's phenomenal the amount of money these mines are going to make, and therefore the share prices will reflect. So it seemed like a really obvious theme. Now there are reasons why it got to that. You had Fukushima, you had Germany, you had huge reactions to these to that accident, quite frankly, that tsunami. But we also thought of it as a solution. So it was interesting that we're not particularly ESG minded. We're mindful, but we're not a company that is solely focused on ESG or climate change. It's part of it. It's a more meaningful and important part of our consideration for sure. But we think the play is also very much a clean energy and therefore ESG, very positive investment to make. And interestingly, and then I'll finish with my long answer, every single client we spoke to, and then I literally only a very few exceptions, totally got it. That it makes a lot of sense. Nuclear energy is one of the only or very few true solutions to the climate change problem that we have, and this was 2 years ago when we were thinking and saying this. So we've had a remarkably positive feedback from our clients, who we thought we had to ask and had to sort of clarify with whether they would be okay with us investing in nuclear, because in uranium, because normally we wouldn't even bother asking them because we have discretionary portfolios. But because of the emotional aspect of nuclear energy, we thought, well, we better check with them. And 90% of them were like, yes, I totally get it. Well done, you, and yeah, go for it.
That is really interesting. I'm glad you shared that. it is or has been for some people like an ethical thing, like not investing in apartheid or something like that, right? Just no uranium, no nuclear power. It's a line in the sand. So to hear that 2 years ago, 90% of your clients were on board with that is really interesting. So you mentioned Fukushima, and of course, what a game changer that was for a time. It set the nuclear renaissance that we're seeing again now, literally back more than a decade. So it's good to see that coming back. It's good to see the new government in Japan really ramping up the restarts, which is a big deal for the near term. So I got to ask though, but we're having this conversation because you're sitting there in Europe, not too far from Germany. Is Germany ever going to come to its senses if where the tsunami hit and they had the incident is willing to restart its nuclear power plants? Will Germany really shut down its last two, and might they reconsider?
I think they are reconsidering. Even one of the green ministers, politicians, said as much as, we should think about this. We should look into this. We should perhaps consider it. Which was just an extraordinary thing to be coming from someone like that. But that will take time. I think Germany. One of the benefits now of the war, obviously, is the refocus on energy, even more so than ever before. Because the vast majority of the oil and gas that Germany consumes comes from Russia, and they want to wean themselves off that by to a large extent by the end of this year, certainly of the oil part. So I think it's become even more urgent for them to really reconsider this. But I don't even know why. I can't explain it, but it is a hot potato. And it's a political hot potato. So I can't look into these politicians' hearts and minds, but there's definitely positive movement.
Well, I mean, politicians.
But we don't need Germany to buy more uranium for the theme to work, right? We already know how many nuclear reactors are going to be built around the world in the next 5 years, because that's 5 or 10 years, because that's how long it takes to build these nuclear reactors. We already know how many there are out there that are going to have to renew their long-term contracts that are sort of all coming, to maturity. So there's a huge predictability, in fact, in terms of the demand for uranium. And the interesting thing is we know that the price of uranium is of no consequence to the buyers. So that's the beauty about the theme as well. You can tell, what the demand's going to be, there's a supply issue, and that the guy who needs to buy it doesn't care what he pays for it, because it's a minuscule overall cost to his input cost.
It is a fantastic setup, I agree. It's why there's so much uranium in my own portfolio as well. But, and you're right, we don't need...
It will be volatile. There's nothing goes up in a straight line, and one has to just, So now for me it's a buying opportunity, because we've had a nice little correction.
Let me come back to it in just a second, but just to wrap up on Germany, we don't need Germany to do an about face for the uranium thesis to bear out and for our investments to work. I get that. But there's this EU taxonomy issue, and there's Germany's opposition to it. It matters. It would help if Germany did come to its senses. The sort of global consensus of nuclear being an essential part of the progress forward would just, I think, accelerate the whole market.
No, it would help enormously, and the sentiment would change, especially from an investment perspective. So, but we think Europe overall, because France is very pro nuclear energy. So there are very diverse views within the European Union. It would be fantastic news for us as investors that if Germany, changed minds. And I'm not sure they're going to hold it up forever. The Europe, the taxonomy that you referred to in Europe.
Okay, so let's pull back to the broader markets then. You shared quite a bit of your time, which I appreciate, but you said something about the current correction being a buying opportunity, and I see that actually in a number of things. In the mining space, there's a sort of bearishness now which seems totally out of proportion to the prices of the metals. I mean, many of the metals are actually at historically high nominal prices, and the better companies are gushing cash, and yet somehow the stocks are on sale. It makes no sense, which to my mind, whenever I see something like that, when price and value diverge, I see that as an opportunity, and certainly I see that in the uranium space right now too. But I'm also very concerned that we could see a market crash in the near term, not to put too fine a point on it. We've got the Fed double tightening that didn't work out so well when they tried it last time, and this time they're doing it on a far more aggressive scale. And by the time they realize they've gone too far too fast, things could have already broken. It seems to be their pattern. They push until something breaks and they go, oh, well, let's pivot here. Does that concern you at all? Are you actually deploying aggressively right now, or are you kind of in a wait and see, let's see how this tightening cycle goes?
Well, I mean, we're not holding a lot of cash, so sadly. We've done some shifting within the portfolio, and we're comfortable where we're at in terms of our geographical, regional and style diversification. So where we've had cash, we've been nibbling, we've been investing, and we think. 3 years from now, we'll look back and say, well, that was actually not a bad opportunity to buy a lot of companies out there at very reasonable valuations. The problem with mining stocks, just to come back to your earlier comment on that, is that's something I learned a long time ago when I first started investing in gold mining stocks. Again, through an expert. I mean, I wouldn't know how to choose them between each other, but. So it's an asset allocation decision for me rather than me picking individual companies. I just look at the upside, the underlying mechanics of whether those companies are likely to be very profitable going forward, or whether it's reflected in the price. So when I see a gap there, then I'm interested and look for an expert and ask them to do the investments. But with gold mining, even if you have the very obvious high profitability. And now with gold mines, even decent yields, because these gold mining companies are now recently actually, they're starting to pay real dividends, right? Which wasn't really the case 10, 20 years ago. So they are very profitable companies, and you can see those profits being generated for the years to come. We had that in the past as well, but they're still stocks. and in many cases, they're small, maybe mid-sized stocks, and they will get thrown out with the bathwater. So, almost irrespective of how good they are as an underlying level, when people hit the sell button, they sell everything.
Yeah.
And those small cap, maybe slightly less liquid stocks get hit hard when that happens. But again, for the more fundamental investor, it's a real opportunity, I think. But you have to have.
Absolutely, yeah. When we got the crash in 2020, I was a little bit slow to buy because I just couldn't imagine the markets turning around so quickly. That was the sharpest V-shaped bottom I've ever seen or read about. I mean, it's just incredible. Yeah. So it's not that I didn't see the opportunity when things were on sale. It's just that I thought they would go more on sale. It was a mistake on my part. But I did jump in on, a little bit late, but I jumped in and I did well. And I don't want to hope for bad things. I don't want to be guilty of Schadenfreude here. But I see a very near-term risk here if markets overreact to central bank tightening of risk to the upside as a buyer. So I've been accumulating cash. What I'm hearing from you is that you don't have that much cash, so nibbling is where you're at. But
we're not selling, because another phenomenon I think that we haven't talked about yet, but that we've become more and more aware of, is is the speed at which, and you refer to it, which reminded me of it, the speed at which the markets are reacting, and the forward-looking aspect of them. I mean, who would have thought, exactly as you said, who would have thought that when we were about, and quite clearly, going to enter into one of the most difficult periods globally from an economic growth perspective, when governments across the world were shutting down their economies. I mean, that had never really happened before. Even during war, they keep the shops open.
Yes.
And everyone, and and people move around. During COVID, people were locked down. Shops were closed. It was extraordinary. And in the face of that, for the market to then bounce within 4 to 6 weeks, knowing that this was all happening, and while it was happening, the market continued to bounce and stay where it was. Absolutely extraordinary. So the speed at which market is reacting to what they think is the likely scenario or whatever 12, 18 months out is staggering. And I think that's also one of the concerns that I have now with this inflation thing, is that a lot of the bad news is already priced into the market. People are expecting the Fed to raise rates to about 3%. For the 10-year. They're expecting Europe to start raising rates a bit. They're expecting inflation to be high. They're expecting, there's a lot of stuff that's already priced into the market. Quite a lot of bad news is priced into the market. And my concern is almost the opposite, that it might not take a lot of light at the end of the tunnel to suddenly
make things take off again.
See the market really changes its mind, and sentiment changing very dramatically, because then suddenly these tech stocks will look, they're 30, 40, 50, 60% cheaper than they were not so long ago. And then people might think, wow, this gotta quickly buy these. But there is a risk that things might be worse, as you've discussed as well. So holding is not a bad place to be if you're confident about the quality of the positions in your portfolio. I think hold. If you feel you're a little bit over or underweight in a particular, defensive growth, whatever area it is, then maybe rebalance a bit. But keep the faith in your conviction, and just be aware how fast things can turn around, and it's absolutely extraordinary.
Well, that's a good positive note to wrap up on. Let me just say one more thing. You also said, 3 years from now we'll look back and say those were good buying opportunities. I absolutely believe that. So, like, if I bought some things that are on sale now, some gold stocks, uranium stocks, copper stocks, things I really like that are 30, 40% less than they were 6 months ago. 3 years from now, I think those will all work out fantastically. 1 or 2 months from now, I could be looking at a 50% haircut on the way to that 3 years from now. But no, this is important, because you're a money manager, and I assume people aren't calling you on a daily basis with the stock market going up and down. So you have time for these theses to work out. I am a newsletter writer with people looking over my shoulder, what's going on now. So a little bit different for me there, but I think that's a really important point, and I would commend this to readers, audience, whether you're my client or not, or Egon's client or not. What he just said, I think, is really important. If you're going to look back on it 3 years from now and buying, whether or not there's a market crash, you think buying something now would turn out to be a very wise decision by then? I think that's something to keep in mind.
As long as you're buying quality.
Yeah, imagine that. Imagine that. Quality matters. Stock selection matters.
It's absolutely key, because just because something's down 30 or 40% doesn't mean it's cheap.
That's true. There's garbage that deserves to be tossed out. There is the bathwater, not just the baby. Okay, well, thank you. This has been very informative. Anything else you want to share with the audience before we go?
No, thanks. It's always great to talk. So look forward to the next one. Hopefully sooner than this time around. That we have to wait for my birthday email exchange.
Well, if I'm right about fireworks ahead, we may be talking in a few months, Egon. Thank you very much.
Okay.
Have a good one.
Take care.
Bye-bye. Thank you for watching this edition of In the Pit with Lobo Tigre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.